Hey everyone, welcome to the KE Report, a daily editorial, chatting with Craig Hemke, founder and editor of TF Metals Report. Now, Craig, interesting, not necessarily in a good way for the precious metals today, as we have gold down almost $100, silver down slightly over $1. Still relatively good price, especially for gold. Gold's still over 2,600. Silver is still holding above that 30 level. The shares, obviously, they're showing some weakness too, but let's just start with precious metals. Gold and silver still in a bit of a corrective phase. Gold, though, again, it's choppy. It's mostly sideways for the last month or two. It's the stocks that are showing a bit more weakness. But Craig, what's your takeaway from how we're starting this week with a pretty significant drop in gold and silver in the face of also a drop in the dollar and yields?
Yeah, that's where the dots don't really connect, right? Because usually during COMEX hours, if bonds are rallying and yields are falling and the dollar is falling, then the algos take over because they do most of the volume anyway, and the metals are well bid. And then I hear things like, oh, well, there's going to be a ceasefire in Lebanon. And so there's a safe haven bid. So wait a second. So the rally last week of $132 was a safe haven bid coming into gold over Hezbollah? I mean, come on. I don't think so. So at the end of the day, this is about option expiration day on the COMEX. I mean, you can try to draw, oh, there's this reason, there's that reason. But I don't know. I don't get it right all the time, but I was warning everybody on my side about this late last week. We had this really nice recovery off of some real washout intraday lows back on Thursday, the 14th. And that was expected because we gotten so oversold. Then we knew that that these expirations were coming. Not only the options expiring here today on Monday, but then the contracts go off the board and go into their delivery period on Friday. And so December for both gold and silver is the only month of the year where both are in a front month. They are actively traded all year long too. Always have open interest. So I mean, this is the biggest month of the year, and so you get these big positions that have been held for a long time, that then are either spreads that get legged out, or they just get rolled, or they don't get fully rolled. You sell 100 December golds, but then you only buy back 50 Februaries, that sort of thing. That's a net selling pressure of 50 contracts. So anyway, all these things come together. And like I said, I started warning everybody next week. I said, this is great. These are nice recoveries, but we're going to have to deal with this last week in November before we can take on December. I just remind everybody, though, nothing has materially changed. This is just your same old stairway up, elevator down pattern. December, though, is seasonally a very good month of the year, as is January. In fact, December has been a positive month for, let's see, started in 2017. So the last 7 Decembers in a row have been positive for gold. About the smallest of which was last year at only 1.4%. The average is about 3.5 to 4. So we'll get through this week. It just is what it is. We'll put it all back together in December, probably rally in the year. I'd expect that economic data in December to suddenly be a little bit below expectations for the first time all year. Now the election's behind us. We'll probably rally in December, do better to January, and take it from there.
Well, Craig, I'm glad that you presented it that way, because if somebody was asleep for the last couple of months from September, gold prices are about the same place they have been. Yes, they've been higher. Yes, they've been lower. They got up to 28. They got down to 25.50. But in general, gold has been in the 2600s for September, October, and November. And the odds are producers in the gold space are probably making plenty of money when you smooth out that volatility and average it out. The average gold price has got to have been in the 2500s to 2600s for both Q3 and now Q4. So when you look at the gold producers, they've sold off hard. And when you look at the GDX, the biggest weighting, like we were talking about off mic, is in Barrick and Newmont. But in general, most of the gold producers, even if they haven't hit expectations, are still printing money here literally at these prices.
And at the same rate they were last quarter. And so when you see some of these high quality producers trading back down to where they were 90 days ago, that tells me the valuation of that company doesn't even take into account how much money they made last quarter. So it's as if that last quarter never happened. But obviously, each company that was making a bunch of money in the third quarter is on an even better financial footing than it was before. So yeah, we are now 5 weeks left to go in the year, 5 weeks left to go in the fourth quarter. these numbers are still going to look really good again as we get into late January and early February. And so I suspect the miners will bounce. Now, you're going to hear a lot. And I keep referring back to my site. It was a week ago today on the 18th. I wrote a comment for everybody. I said, look at these 4 charts. I looked at Agnico Eagle and Alamos, Lundin, and Kinross. And we were just starting to recover on Monday. And I said, well, you can see where this is going. These are going to roll up, and all 4 of them are going to paint the right shoulder of a head and shoulder top. And then once those are in, oh man, are you going to hear it from people, the perma bears and everybody else on Twitter and places like that. Oh, look at the head and shoulder top. The mining shares are dead. And now that's exactly what's happening. It's remarkable. I would imagine, again, we probably have another couple of weeks of the mining shares and the GDX not doing much. That's typical. Usually a lot of the tax loss selling, and who knows how much there is this year, wraps up by about the 15th to 18th. Maybe as late as the 20th of December, and then you get this rally in the mining sector that begins last week of the year and carries into January, and this year will carry into the next earnings period. So any mining enthusiasts, you just kind of lick your wounds and look the other way and don't check your account today, and we'll just see if things can't be better by a month from now.
Craig, was everybody in the resource sector simply just too bullish? It had been a good run for the precious metals. The stocks had done very well almost across the board. Yes, I know some of the juniors lagged, but pretty much everything was moving higher at some point over that last 8 months. And honestly, all we heard from commentators was what could go wrong? Everything's lining up to further support gold. And then all of a sudden, the start of Q3 earnings season and the election kind of turned it on its head. Again, I'm a bit more worried about some of the stock charts like GDX and GDXJ, but overall, was everybody a bit too complacent in the precious metal sector?
Guys, when did we start doing these calls? I can't remember.
I would imagine 5 at least years ago.
It has 10 years. I have to imagine that at some point I've mentioned to you guys the most tried and true adage that we have at TF Metals Report. And that is, if you are trading the precious metals and by extension the mining shares, you must always be prepared to sell some when things look the most rosy. Conversely, you must always be ready to buy some when things look, the most dreadful. And no doubt, end of October, right before the election, things look pretty rosy, and look what happens. You could say 14th and 15th of November, things look pretty dreadful, and look what happens. So that's something everybody should always keep in mind. If you're trading, if you're a stacker like me, you don't worry about that stuff so much. But I do think, again, just to reiterate, I don't think the math has changed. I'm pretty confident that the certainty of the budget deficits and the debt and the management of that is going to be a big story in 2025. All of this leads to stable and rising precious metal prices, and by extension, probably the mining sector. But again, to your point, though, I guess with one of your points, Corey, you just can't underestimate the damage done to sentiment by Newmont and Barrick, because they are the alleged flag bearers. They're the biggest producers. I mean, Newmont's 14% weighted in the GDX, and they have such incredibly high all-in sustaining costs that Newmont's share price is basically the same it was 20 years ago. And that's because their margins haven't changed. Their expenses go up just as fast. It's like you, Corey, pulling down $1 million a year, running this website, but your expenses go up just as fast every year. You don't save any money, right? Your net worth never goes up. And you got to live more responsibly. You got to control your expenses so that you have some leftover money, and your personal net worth goes up. Well, these mining shares never do that. Well, the problem is, anytime anybody gets interested in the sector, they call their stockbroker, they look. Even Stan Druckenmiller does this. Well, I'm going to get some exposure to gold, so I'm going to buy Newmont. Come on, you can't. It's impossible for you to be that intellectually lazy, Stan. I mean, you're the most recognizable, most prosperous hedge fund manager in history, but even he buys friggin' Newmont without doing any homework. So when Newmont and Barrick inevitably disappoint, as they did back in late October and early November, it just wipes out the sector. And so, yeah, GDXJ and everything else, the charts are struggling, mainly because of those two. But it does present an opportunity for those willing to listen to you and Shad and do their homework and all that kind of stuff to unearth some opportunities, and they're definitely out there.
Well, and Craig, just to that point, do you think that maybe the problem with the gold sector from a generalist perspective is that they only pile into Newmont and Barrick? They probably don't even realize that Agnico is now the second biggest, not Barrick. And that when you look at other charts, like you brought up Kinross, look how well it's done this year. Look how well Alamos has done. We've talked about that a lot. Look at Wesdome, it's double. Look at IM Gold. So there's a lot of companies you can invest in if you're a stock picker versus a ETF buyer, and you can blow away Newmont and Barrick. To your point, Newmont and Barrick, I think Adrian Days brought this up like 10 times on our show. Newmont and Barrick are the same prices they were decades ago, and they haven't gone anywhere. The money when you make in the sector is not in Newmont and Barrick, but that's where generalists go. Is that the problem? Because the money to be made is in the mid-tiers or in the smaller producers or in the developers. It's really not in the big boys.
And that sours the whole sector. And it creates a little bit of a negative feedback loop, because their weighting is so heavy in the things like the GDX and the Hui index or whatever you want to choose as a proxy for the sector. Those things disappoint. The people that, late comers that don't know any better, that bought them, they blow out. That wipes out the GDX on a disproportionate level. And then all of a sudden that people go, oh, look at the GDX, so the sector's in trouble. I got to start paring back my other ones. And you get this, like I said, negative feedback loop. Look, I don't want to make it sound like it's all doom and gloom. I'm very confident that the precious metals will have another good year next year. Now, whether that means there's enough investor interest in cash flow to make all the shares go up and make things like the GDX go up, I don't know. It remains to be seen. But the situation is such that it's still going to be positive for gold and silver. And you would think that would at least stabilize things in the mining sector.
You would think so, but like as much, I guess, complaining as we are doing about how investors look at the gold sector, we do just need to understand that we're not changing the way people look at the gold sector. That is the way people invest in the gold sector. So if we are looking at any of the charts, what do you look for, Craig? If we look at the stock charts, and that's what I'm more focused on. Again, the metals are still doing pretty well, especially if silver holds above $30 an ounce. I know their support zone slightly below that, but over $30 an ounce is strong, and gold just where it is, man, that could drop even a few more hundred, even $5 more and still be fairly strong. But when you look at something like GDX, GDXJ, what sort of levels would worry you then? Because you don't sound worried at all about this. Really, it's only been about a month-long change in direction here.
Well, if you wanted to have a level to get worried about, look at 33 on the GDX and pull up a really long-term chart, because that was the level that was support at one time and then became resistance for a long time. If you were to fall below 33 and remain there for a couple of weeks, a month, that would be worrisome. But again, now we're talking about that would have to happen in a situation where gold goes back to 2,200 or 2,400 or something. And I just don't see that happening. This has, you talked about, mentioned earlier, Corey, the overzealousness, and everything always gets that way. It's not just a gold and silver phenomenon, obviously. But everybody was excited, and wow, what can stop this? And then you get this election of Trump. And it was almost hysterical, the action that followed. And I mean that not like funny, it almost like a mania or a hysteria took over. In that suddenly this was a sea change in the debt-based system. That the $1.8 trillion in U.S. deficit last year was suddenly going to be trimmed to $180 billion. That's not going to happen. And, this notion that Musk and Vivek are going to get in there with like a line item veto and just start slashing the budgets of all these departments. That's not how it works. I mean, they can make recommendations, and Congress can try to pass, they don't even do budgets anymore. They do appropriations bills and omnibus spending packages. So they can make suggestions, but whether that would ever actually sail through, anyway, so what I'm saying is this idea that gold fell 10%, largely driven because it began the very next day after the election by this, that suddenly the math has changed. It's just nonsense. It's just nonsense. And so we are going to continue to run. Deficits are likely even to get worse next year as tax revenue falls with a worsening economy. And then what do you get? So the fundamental picture for continuing to own and buy more gold, whether it's at the retail level, the institutional level, or the central bank level, has not changed. So we'll take a day like today, understand what it is. It is what it is. And you can use the weakness to add to your stack. And if you get to the point where a particular mining company reaches a compelling valuation, add to that too.
Well, Craig, we've mostly been talking about gold and the gold stocks in this. We've been looping silver along with gold as a precious metal, but silver doesn't always move like gold. And generally it will trend like gold, but it is 60% industrial now, and it would have more potential opportunity in a weakening dollar environment or a threat in a strengthening dollar environment, but also it has, an impact on how the economy does go if we do see a recession next year. So are you looking at silver a little differently than gold, or are you just looping them in together?
Hey, let me give you this one. You guys remember from earlier this year, remember we talked about the monthly and the quarterly chart of gold and how it was breaking out above 2100 and how important that was, because it's those very long-term charts that reveal the kind of secular bull or bear market or breakout. Okay, we sit here and we're going bananas today over the daily chart and the hourly chart. The guys that run, that really could flow money into the sector, the home offices, the institutions, the hedge funds and the like, they look at the long-term charts. And that's why the monthly breakout, the quarterly breakout in gold is then what drove it up 10% in 6 weeks, right? All right. Silver, despite having, great periods, whether it was, 1980 or, whatever, 2011, the highest annual close for silver has never been above 32 at the end of the year, ever. So now, like we're recording this on a day where silver's falling back toward 30, and you think, oh, God, is it really going to rally 6% in December? Well, it might. And if it were to close on New Year's Eve, somewhere up around, 31.50, 32, and it's the highest annual close of all time, that's going to get some attention. I mean, how could it not? And that might set up a very interesting 2025 for silver, because as you mentioned, Chad, the industrial demand, combine that with what could be a growing investment demand and really worsen that supply deficit, things could really get funky next year, especially, again, if that kind of long-term trend reveals itself with the highest annual close of all time.
All right, we'll wrap it up here. Again, Craig Hemke, founder and editor of TFMetalsReport.com. Craig, we'll be touching in with you on a weekly basis moving forward here to see how December acts, how we close this year, and then even more importantly, what next year holds for the precious metals. Always great chatting with you, Craig. Thanks for your time today.
Thanks, man.